Chams Holding Company just told investors something that sounds like good news. Profit for the half year grew by 13%. But if you were holding Chams shares before this year, your actual slice of that profit didn't grow at all. It shrank by 41%. How does a company's profit go up while every existing shareholder's claim on that profit goes down? And here's the part that should make any careful investor sit up straighter. When we went looking for what actually drove that 13% profit growth, we found it wasn't coming from selling more identity verification hardware, or growing the payments business, or winning new government contracts. It was coming from a single line item that grew almost 30 times larger than it was a year ago, one the company never explains. Meanwhile, the part of the business that's supposed to sustain a company over the long run, its actual operating profit, fell by 44%. So which story is true? The profit growth on the headline or the deterioration underneath it? Today, we go looking for the answer. Welcome back to Behind the Numbers TV, the channel that breaks down financial statements in plain English. No finance degree required. Today, we're looking at Chams Holding Company PLC's unaudited results for the second quarter of 2026. At the time of this analysis, the company's shares are trading around 4 Naira 59 Kobo. Before we get into the numbers, one honest disclosure. This filing has some genuine documentation problems. Numbers that don't add up to each other inside the same document. We're not going to paper over that. We're going to flag it clearly, the same way we'd flag any other red flag, because it matters for how much confidence you should have in everything else we're about to discuss. Let's investigate. The first question we typically ask is the business growing? Before we examine the evidence, it's worth understanding how Chams actually makes money. Chams operates in Nigeria's identity management and payment technology industry. Biometric hardware, BVN verification services, data card products, e-voting systems, and a handful of newer digital products. It's been listed on the Nigerian exchange since 2008. Despite the growing list of digital products, the business still relies heavily on two traditional product categories. Data card products, which contributed roughly 4.32 billion Naira, or 44% of total revenue. Biometric and counting equipment, which generated another 3.45 billion Naira, representing about 35%. Together, those two businesses produced almost 80% of total revenue. That concentration means the company's fortunes still depend heavily on a relatively small number of product lines. Which brings us to the first clue. Revenue barely moved. During the first half of 2026, revenue slipped slightly from 9.88 billion Naira to 9.79 billion Naira. That's less than a 1% decline. On its own, that isn't alarming, but looking beneath the half-year numbers reveals something more interesting. Second quarter revenue fell 7% compared with the same quarter last year. That's a meaningfully sharper decline than the half-year number suggests, which raises a real question. Is this a recent deceleration that the 6-month average hasn't fully caught up to yet? Now to profitability, and this is where the story gets more encouraging. Gross margin, simply how many Kobo of profit survive out of every Naira that comes in the door after the direct cost of producing whatever was sold, improved sharply. It climbed from just under 20% to just over 26%. Cost of sales actually fell nearly 9%. That's a genuine operational improvement. It tells us the company became more efficient at delivering its products. If the story stopped there, we'd be looking at a genuinely improving business. But it doesn't stop there. Administrative expenses exploded. They jumped from 1.20 billion Naira to 2.05 billion Naira, an increase of more than 70%, and the filing doesn't explain why. No note breaks down what drove that jump, whether it's new hires, a one-off cost, or something structural. Operating profit fell from 948 million Naira to just 529 million Naira, a decline of 44%. Operating margin also shrank from 9.6% to 5.4%. So, despite stronger gross margins, the underlying business actually became less profitable. Next, we discovered something unexpected. Despite operating profit falling 44%, profit before tax actually rose almost 15%, and profit after tax rose 13%. If operating profit fell, and yet the profit above it went up, something below the operating line did a lot of heavy lifting. Let's find it. The answer is a line called finance income. This is essentially money the company earned from investments, interest, or similar financial sources, separate from anything to do with actually running its core business. Finance income increased from just 18.1 million naira last year to almost 538.8 million naira this year. That's nearly a 30-fold increase. I'll say that again. Finance income alone, a line that has nothing to do with selling hardware or processing payments, is now larger than the company's entire operating profit from running its actual business. The business itself generated 529 million naira in operation profit, but finance income contributed 539 million naira. If finance income is stripped or normalized to what it was a year ago, then profit before tax doesn't grow 15%. It falls drastically by almost 83%. That's why earnings quality matters. Headline profit grew by 13%, but the core business did not. The filing also doesn't explain exactly what caused this huge increase in finance income. Without that explanation, investors can't confidently assume it will happen again. The investigation also uncovered another concern, one that genuinely matters for how much you trust everything else in this filing. The cash flow statement in this report doesn't add up. The profit figure used in the operating cash flow reconciliation doesn't match the reported 6-month profit. Even more concerning, the cash balances reported in the cash flow statement don't agree with the balance sheet. To be clear about what this means and doesn't mean, this doesn't prove the company is hiding something. It's very likely a drafting error in an unaudited quarterly filing. These happen. But it does mean we can't fully vouch for the cash flow analysis that follows, and it's a real documentation quality concern in its own right, on top of everything else. Taking the reported cash flow numbers at face value, operating cash flow was negative 1.14 billion naira, even though reported profit was 473 million naira. That's a negative cash conversion. Profit on paper, cash going the other direction. The company also invested heavily, spending around 1.82 billion naira on property, plant, and equipment. Most of that investment appears to have been funded through new borrowings. So, can we trust this quarter's profit growth? No, not on the evidence here. The operating business deteriorated. The profit growth came almost entirely from an unexplained financial item, and the statement meant to confirm whether any of this turned into real cash doesn't even reconcile with itself. Now let's look at the business from the shareholders' perspective. This is where our opening mystery gets its answer. Profit attributable to shareholders increased from roughly 339 million naira to 449 million naira. Yet earnings per share, how much profit belongs to each individual share, fell from 8 naira 92 kobo to 5 naira 26 kobo. That's a decline of 41%. The reason is simple: severe dilution. The number of shares in issue rose from approximately 4.7 billion to 9 billion, an increase of almost 92%. Every shareholder now owns a much smaller percentage of the company than they did a year ago. This is why investors should never stop at total profit. Per-share earnings tell the real story. Book value per share tells a similarly muted story. It rose only slightly, from about 1 naira 50 kobo to about 1 naira 55 kobo. Real growth, but modest. Total equity may have grown more meaningfully, but spread across nearly double the shares, the improvement per share is thin. On dividends, there's nothing to report. No dividend note, no distribution disclosed anywhere in this filing. Income-focused investors get no signal here either way. So, did shareholders benefit? On the one number that matters most, earnings per share, the answer is no. Existing shareholders are worse off on a per-share basis than they were a year ago, despite the company reporting higher total profit. Back to the business. Let's look at how management did. Total assets increased slightly from 34.38 billion naira to 35.74 billion naira in just 6 months. The balance sheet didn't change dramatically overall, but one number stands out: borrowings. This is the clearest clue to what management actually did during the first half of the year. The company almost doubled its debt, increasing borrowings from 1.93 billion naira to 3.75 billion naira in just 6 months. Where did that money go? Into new equipment. Property, plant, and equipment jumped from 2.86 billion naira to 4.91 billion naira, an increase of about 72%. In simple terms, management borrowed money to invest in the business. Now, at first glance, the company's short-term financial position actually looks slightly better. Its current ratio, a simple measure of whether it has enough short-term assets to pay its short-term bills, improved from 1.57 times to 1.67 times. Normally, that would be a positive sign. But remember what we discovered earlier. The cash flow statement contains reconciliation errors, so we can't place the same level of confidence in these figures as we normally would. There's another number worth watching. Customers owed Chams 14.23 billion naira at the end of the period. That's about 1.5 times the company's entire 6-month revenue. It doesn't automatically mean there's a problem, but it does suggest the company takes a long time to collect money from customers, and that's something investors should keep an eye on in future reports. One final point. Chams is still carrying losses from previous years. Those accumulated losses have fallen from 1.27 billion naira to 795 million naira, which is definitely progress, but they haven't disappeared yet. So where does that leave us? Management did make one genuine improvement. They became more efficient at producing their products and services, but they also allowed overhead costs to rise sharply without a clear explanation. They financed a major expansion mainly by taking on more debt, rather than using cash generated from the business. And perhaps most importantly, the reconciliation errors in the financial statements mean investors should treat the reported cash flow with caution until those issues are properly explained. That brings us to the final question. Is the stock worth buying today? At the current market price of approximately 4 naira 59 kobo, annualizing the half-year earnings produces a price-to-earnings ratio of roughly 44 times. Let that sit for a moment. A price-to-earnings ratio in the mid-40s is a valuation normally associated with a fast-growing technology company confidently expected to compound earnings for years, not a business whose actual operating profit just fell 44%. Against book value, the picture is somewhat less extreme, but still rich. The stock trades at almost 3 times book value. Investors are paying nearly 3 naira for every 1 naira of the company's reported net worth. So what is the market actually paying for at this price? Almost certainly not this half's operating result, since that deteriorated. The valuation only makes sense if you believe 2 things: that the mysterious finance income is a genuine, recurring feature of the business rather than a one-off, and that management can bring administrative costs back under control while the core cost of sales improvement holds. Neither of those beliefs is currently supported by evidence in this filing. They're assumptions an investor would be making on faith, not on what's actually been demonstrated. So what's the verdict? For new investors, avoid. At a price-to-earnings ratio in the mid-40s, the market is asking new investors to pay a growth stock premium for a business whose operating profit just fell 44%, whose reported profit growth rests on an unexplained and probably non-repeatable financial item, and whose own cash flow statement doesn't reconcile with itself. There isn't enough evidence here to justify new capital at this price. For existing shareholders, hold but monitor closely. This isn't a company with evidence of the kind of acute distress that would justify an urgent exit. There's no negative equity, no loan default, no going concern warning. But it is a company where the numbers you'd want to believe don't survive close scrutiny. Watch the next 1 or 2 reporting periods closely for 3 things: whether operating profit stabilizes or recovers, whether the company explains the source of its finance income, and whether the cash flow statement is corrected and reconciled properly. If none of those improve, the case for continuing to hold weakens further. That's it for Chams Holding Company PLC's unaudited results for the second quarter of 2026. If there's one thing to remember from today's analysis, it's this. A profit number going up is not, by itself, evidence that a business is getting healthier. Before we wrap this up, remember, this video is not financial advice. It is for educational purposes only. Always do your own research or consult a licensed financial advisor before making investment decisions. Now I'd like to hear from you. At 4 Naira 59 Kobo, would you buy Chams Holding Company, hold what you already have, or stay away entirely? Let me know in the comments below. If you enjoy evidence-based investing without the hype, like this video and subscribe to Behind the Numbers TV. Also, turn on notifications so you never miss our next deep dive into the Nigerian stock market. Because every number tells a story, and together we'll learn how to read it. See you in the next video. Thanks for watching.